Hello. This video is designed to give you an overview of how onshore investment bonds are taxed and the advantages they can offer some of your clients. We will look at how simple they are for an investor to administer and some of the key tax advantages. Now, an onshore bond is simply a tax wrapper, and you will have clients that are more suited to an onshore investment bond than an offshore bond or a collective, and so on. Each client is different and their needs should be considered each time. And a blanket solution for all clients or the majority of clients may not be the best approach. Everyone is individual. Unlike some other investments or tax wrappers, an onshore investment bond will pay some tax within the fund. Some may consider this a disadvantage, but it can be an advantage. A life fund pays corporation tax on the income it receives and any gain it makes. UK dividend income is taxed at 10%, and this is covered by the withholding tax deducted at source. Other income, such as interest and rental income, is taxed at 20%, and any capital gains achieved by the fund are also taxed at 20%. However, they get indexation relief on capital gains linked to the RPI. Therefore, if there is a gain of 3% within the fund, and inflation is also running at 3%, the gain is effectively tax-free. These taxes are equivalent to the 20% basic rate of income tax, and as a result, this is treated as being paid within the fund. The actual tax paid in the fund will vary depending on the type of assets held, the investment performance, and the prevailing economic conditions. Also, no tax charges apply for any fund switches carried out within the bond wrapper when changing the underlying investment. This can favour those seeking active management or who want to periodically rebalance their investment. Lastly, an investor is able to withdraw an amount equal to 5% of the original investment each policy year without any immediate tax liability. These are sometimes referred to as partial surrenders, and for tax purposes are considered to be a return of capital. This allowance is cumulative, and unused amounts can be rolled over to subsequent years, allowing the investor to take a flexible, tax-efficient income. So what tax does an investor have to pay personally? A bond can grow without any personal tax charge and without any need to disclose income or growth, providing withdrawals are within the 5% allowance. This makes bonds ideal for those who want a straightforward investment and minimum paperwork. However, investors may have tax to pay when a chargeable event occurs. A chargeable event is when the last life assured dies, a policy is assigned for money or money's worth, but note this does not include when a bond is gifted away. It matures, although in general most bonds are open-ended. The 5% withdrawal amounts are exceeded, or on full surrender. When one of these events occurs, the profit or gain from the bond is calculated. For a death claim, assignment for money or money's worth, a maturity or surrender, we take the amount of the surrender value plus any of the 5% allowance that have been used. We then deduct the amount invested plus any previous withdrawals over the 5% allowance. This gain is then chargeable in the tax year in which it occurs. For an excess withdrawal, it is much easier. It is just the amount over the available cumulative 5% allowance that has been taken. And as the bond is still in force, it is assessable in the tax year of the next policy anniversary. This could be the current tax year or the next one. Now, a non-taxpayer cannot reclaim or make any allowance for the tax paid within the bond. A basic rate taxpayer will have no further tax to pay, providing the gain, when added to their income, does not make them a higher rate taxpayer. If it does, they are able to use a rule referred to as top slicing to spread the gain over a number of years. Higher rate taxpayers will pay just 20% on the net gain, and additional rate taxpayers 25%. But what do I mean by net gain? Well, let's consider an example. If a gross interest payment of £100 is received in the fund, as I've mentioned earlier, tax will be paid at 20%. On surrender, this gives a net gain of £80. Now, a higher rate taxpayer will pay 20% tax on that £80 gain, giving an additional liability of £16, leaving £64 out of the £100. This means that overall, they will be paying tax at only 36% rather than the 40% they would normally pay. And when withdrawing money, onshore bonds offer great flexibility. Generally, they are written as a series of identical policies. This allows the choice of partial surrenders across a number of policies if there is sufficient allowance to do so, or surrender individual policies in their entirety. A combination of the two may also be appropriate, and this can allow encashment in the most tax-efficient way. A bond can therefore be a very good investment solution, and the internal taxation can work in the client's favour. It can also provide tax-efficient access to capital and income should a client need it, without any immediate tax or reporting requirements. We do not have time to go into the individual calculations in detail, and we have produced a number of tech casts on bond taxation that can be found on our technical services website, or you can speak with your account manager. We hope you found this video of use. Thank you and goodbye.